Good morning, everybody, and welcome back to the Schwab Coaching Channel. Today, our next topic is getting started with options, and we are discussing the building block number one, that is to say, long calls. So, ready to get down to business with all of you. Thanks for joining me today. You can say hi to my friend James Boyd there in the chat. He'll certainly keep an eye on all of you today. Make sure that questions that I am unable to get to in the moment do get addressed. So say hi to JB for a moment if you'd like, and certainly feel free to drop your questions in today. Of course, as every segment is, we want to hear from you. They're engaging and interactive, and your questions will certainly help a lot of other viewers as well. Remember, we're all here learning to a certain extent, especially in today's class, as we are really digging into one of the more basic option strategies, that being a long options, long calls, buying long calls, etc. So we're going to kind of lay that foundation, but your questions are totally valid and we'll be happy to address them in the moment as best we can. So send those off, everybody. And if you're not already doing so, of course, follow JB and me on X at James Boyd CS and at Kevin Horner CS. We'd love to have you follow us. And of course, bring us your comments and questions. I see some familiar names here in the chat, names that I engage with there on Twitter as well. So yeah, I'd love to have you do that for us and get with us outside of the classes we host, everybody. That X is the best place to do that with us. All right, let's get to some disclosures so that we can dive into the discussion today. Remember that our conversation is exclusively informational and educational. We do not make recommendations. We do not endorse a particular strategy. That's important to know today because, of course, we're talking about long calls. We are not endorsing the use of long calls, but simply providing a foundational understanding of call options, how to utilize them, and what traders might consider. In fact, options do carry a higher level of risk. You need to be aware of that. Further, you want to be familiar with the characteristics and risks of standardized options. At Schwab, we ask you to be approved for each account on which you would like to be an authorized agent and trade options, of course. So make sure you go through the requisite steps before you get yourself all ready to go and place those trades. You do need to have your approvals set in advance. Additionally, it's important to know that you can absolutely set various levels of option trading authority on a per account basis. And then last note we're going to make today as it relates to the options really is just in regard to the paper money platform, that being a portion of the desktop Thinkorswim application that we utilize here. Just remember that while when we place trades and options, you might not have existing or real life examples carried out all the way, meaning there won't be early assignments or will not be opportunities for you to exercise your contracts, for example. So just recognize that when working in paper money, there's going to be a little bit of discrepancy in terms of allowabilities. But we do want you to know that those are things that can occur with live action, live market trades. So please certainly be aware of that. Okay, so today, our agenda, as I stated, kind of basic. We're going to learn the basics of buying calls. What do traders think about when they're buying calls? Why do they step into those trades? We'll consider some points of importance, things to carry with us. These might be things that you make note of for yourselves, things to put on a plan sheet, something that you might keep alongside your trade monitors here so that you can give yourself something to refer to. So we have some calls to action and some takeaways for you there as we work through the end of things. And of course, we are absolutely going to place an example trade today utilizing the Thinkorswim desktop application. So let's cover some of these basics for you all today, everyone. So what is it we're talking about with call options, and what is a call? Well, the opportunity involved with a call option. A call is essentially representation of 100 shares of the underlying stock. And when we talk about buying a call option, essentially, we are doing the same as we would if we were purchasing 100 shares of the underlying security. Now, the difference here is in buying a call, you are buying the right to own stock at the specified strike price. You are not, in fact, buying the stock. So you have to be aware that you are not getting everything that the shareholder would get. You will not, for example, earn the right to earn a dividend if the company pays one. that does not apply to the long call holder. Further, voting rights do not apply to the long call holder. Only at the time that a long call holder chooses to do something with their call option, that is to say, accept shares and trade in their option, for example, at the price that the contract designates for 100 shares of the underlying stock, they can make that decision, and then they would have entitlement to dividends or to proxy voting and voting rights. But essentially, the call option does not give the investor that opportunity. So the goal in buying a call option, of course, is much like buying the underlying stock. We expect, if we are buying the long call as an initial entrance into a position, that we are going to see the price of the stock rising in value in the window of time designated by the contract. So it's important to remember that call options, put options, as we will get to next week, options all have a finite life. And it is that finite life that often plays a big part in new traders and those getting started in options. It plays a big part in understanding how prices fluctuate, because prices of option contracts won't move much like the underlying stock unless maybe we are working with contracts that are very deep in the money, and we could certainly explain the concept of that as we move on through things here. So, of course, when we're buying a call from the base level of, I'm going to be looking to buy a call option, I believe the stock is going higher. We want to take advantage of that movement to the upside and might very well simply look to buy the call option and down the road sell the same call option at a higher price as evidence of the upward momentum or upward trajectory of the stock. One thing that a lot of option traders like from buying of options is the third bullet point here, that the maximum potential reward on a long call option is truly unlimited. And that is because we never know the ultimate price to which a stock can move. In fact, price action to the upside is always unlimited, right? Prices can, in theory, always keep climbing for us. So to that extent, price will always reflect as unlimited reward, but that's not necessarily a valid way to look at it, because as we get to a question here from Sai about how to cut losses on a call option, well, for a lot of traders, everybody, the consideration isn't should I be spending $100 to buy this call option, and if it drops to market value of 50, I'm going to sell it. You can do that and take a loss. But for a lot of traders, everyone, they simply decide that the amount of money that they put into the call option is their worst case scenario is the loss entirely of the amount of that investment. Now, for some of us, that doesn't sound great, and I understand that. However, if you were to consider that you expect your investment in a long call option to go from the $50 that I've invested down to zero, well, if you have that zero expectation, the odds are it's going to dissuade you a little bit from putting on a position that exceeds that comfort. Meaning, if you said, I'm comfortable losing $50 right here, right now, it might be the best approach for some traders to simply say, I won't spend more than 50, rather than saying, oh, I'll spend 100, and if the market value drops by $50, I'll spend 100. If it drops to 50, I'll just sell it and I'll admit I was wrong and move on. Well, think about it like this. Remember that finite window, right? We have a window of time in which the stock can move and can give the option trader benefit. Well, sometimes that trader just says, I'd rather have that window and spend only what I'm comfortable losing and just give the option contract the entirety of that window of time. And if I'm expecting it to move from $50 in value to zero, and it does anything other than that, I'll be pleasantly surprised and I will look to sell for profit. But ultimately, it's a possibility that that concept might give the trader a little bit more comfort in managing their option position, simply because every trade they make, they expect it to end up at zero. And that can give you a little bit more understanding of what you might consider to be true risk. Okay, so that did kind of deviate a little bit off the option conversation, and yet very important. And for those of you who are familiar with many of the classes that I teach here, I often will talk about management of emotions and management of risk, and those are big components. Don't allow the opportunity that an option contract, a call option provides, to dissuade you from viewing your worst case scenarios. Always be think thoughtful on your worst case situation so we don't exceed our comfort zone. Okay. All right. So at the last bullet point here, should the long call position expire worthless, the entire cost is lost, right? So what does that mean? What are we talking about when we get down to the nuts and bolts of what a call option is? Well, a call option provides us this max gain benefit, right? The leverage opportunity to spend far fewer dollars, but get the same return that someone who was going to buy 100 shares could get. As we will see in market values, I'll show you this momentarily, everyone. We're going to talk about the ability to utilize leverage, which is essentially what a long call can provide for us. The benefit of the time frame is to recognize that the life of the contract is finite, and we as the traders are going to look for our move to occur as early in that finite window as possible because of something that we know as time decay. That'll fall under our potential risks section down below. Time decay works against the long option holder. Now, today, since we're talking long calls, we ultimately need to see prices of the stock we're purchasing. Price of the stock needs to move higher. That has to happen in a time frame consistent with our window for the contract being alive for us. But it is that decay that will literally erode your price value, even if the stock doesn't go down. So in theory, if you have a contract's life for 5 days that you bought on a Monday that expires on Friday, and you expected the stock to be rising, but instead of rising or even not falling, it's just kind of meandering sideways. There's no real action behind it. There's not a whole lot of volume, and prices just stagnated for 2-3 days. You would witness the market value of your option contract losing each and every day by a value commensurate with the price action of the underlying stock. So if we literally went nowhere for 3 to 4 or 5 days in a 5-day contract, well, the odds are that over that 4 to 5 days, even the value that you stepped in at is just going to be diminished, and step lower, lower, lower. You're losing value every single day. Okay, so holders of the long calls, as we stated, we do not capture dividends. We do not have voting rights or proxy rights of any kind. So we have to keep that in mind. But ultimately, as we're going to see, some of the big keys involve that leverage and the opportunity to participate in a move for a lot fewer dollars than you traditionally might need to devote to a trade. So which securities might be the kinds that could be good candidates for call options? Stocks that are already in a bullish uptrend can be opportunistic for long calls. Stocks with higher trading volumes can also be opportunistic because, of course, higher volume can lead to volatility, and volatility can lead to big moves in price action, and that's that bigger move in price action that really can benefit the option trader. Options with higher trading volumes can also be important to consider. So many of you might have, if you're out there in the world of X and you're following traders consistently, you might have come across some who are talking about unusual option activity. That is to say, stocks that don't generally show options, but all of a sudden there's a big position that's placed in there. Or there's stocks that are very, very active and show many thousands of contracts at many different strike prices traded throughout the day. that volume of actual volume in option contracts, as well as the underlying stock, can greatly play on the value of the contract itself. That's also an important aspect to keep in mind. Okay, so we've got option volume, you've got underlying equity volume. We've got to consider stocks or option contracts with tight bid ask. Ask yourself, why would that benefit the option trader? What about a contract that is nice and tight in terms of its bid price versus its ask? If it's $2 by $5, right? A bid at 2, offered at 5, well, that's extremely wide, and that gives the impression, and in truth, it is becoming an illiquid contract at that manner, right? Because in order to profit from said opportunity there, you're essentially being a buyer at $5 a contract, and your immediate opportunities to sell at 2. It tells you that there's not a lot of action in between. There's not a lot of volume in the option contract. We prefer, if you think about it as a long option trader, the long option holder wants those tighter spreads because it provides liquidity for your contract, right? And it's not to suggest that your long contract holder cannot sell their contract. You can always sell your contract. However, you want to be selling it favorably, right? And the tighter your spreads, just like it is with equities, the tighter those spreads are, the better fills you're going to tend to get out of those sells and purchases on both sides, truth be told. So one of the other things we speak to here, everybody, the hold move. I think this is very intriguing for those of you looking for opportunities to participate in the beginning stages of a bounce maneuver. So we also comment here, bouncing off support. Yeah, if you have seen, for example, a stock come down and hit support and test and hold, the day after making the low, you close above the high of that low day, that can be the first indication that the trend is going to move a little bit the opposite, right? The opposite of what we came into it with. And you can look for your opportunity that way for a quick play, a quick bounce, if you will. That'll give the trader the opportunity to capitalize in the short term. All right. But we have to, as always, consider our time frame. And that's where things become really tricky for those of us just getting our feet wet with options. It can be difficult to really assign time. The tendency, as I have learned, is for traders to put less time on the contract series, which is to say, instead of thinking to next Friday, for example, many would start thinking about this Friday, only 3 days down the road. Yes, with only 3 days remaining, that contract for this week is likely to be a lot more affordable, all things equal. But if we go forward another week and you add 5 market days to the mix, yeah, the value of that contract is certainly going to be higher in most cases. But at the same time, it might be the manner that gives the trader a little bit more opportunity, right? Remember, the market does what the market's going to do. Rarely does the market do what it's going to do in our time frame. So be thoughtful about your process. If you can afford to add more time to your trade, it might behoove you to do so. There is nothing wrong with adding more time to your trade and still selling quickly should the move that you expected or anticipated develop. You don't have to stick with your contract for the life of the contract. You can absolutely choose to be a seller of a long option at any time. And I think this is one of the things that I want you to take away today. And that's just a reminder that regardless of the window of time remaining on your contract, if you're looking at it and you have profit and you say, boy, that profit came a lot quicker than I expected. I spent $100 and suddenly it's valued at $400. I can walk away with $300 net, take some profits, pat myself on the back, and I could do pretty well with that, right? You could also stick with the position for the remaining 10 days, 2-3 weeks, however long remains. But a lot of traders tend to do the latter. They hold instead of looking to take profit and perhaps redistributing the profit rather than their original investment. And this can really become challenging when the trader is only taking on a single option contract. So in my example of buying a contract for $1 or $100 net, as we'll see, and then getting to profit very quickly, right? Let's say the contract has 21 days and 3 days into it, you're at 300%. You went from 100 to 400. A lot of traders would wonder, should I keep that position? Should I sell it? Well, I think if you sell it, one of the considerations should be sell it, take your net profits, right? And then take that original $100 that you put into that trade and just find another if you still like the opportunity, that is, in the same stock, pick a different strike price where you can afford to devote another $100, and you just put that money right back into the same trade, and then all that profit resides on the sideline for you to distribute to other opportunities. The point being, you don't have to be tied to your expiration date, okay? You can always be a seller early, particularly for profit. But please remember what I suggested, what I brought as an idea that some traders bring to the table for themselves, which is not to exceed the amount of money on a long call. Never put more in than you are comfortable losing. That can be a very simple, easy walk-away process to get you started in trading options, okay? All right, so let's move to Thinkorswim Desktop. Let's pull this up and let's start talking about this from a little bit of a more detailed fashion. Initially, I've got the S&P 500. We're going to get off of that. We're sticking with equities today. Let's look at Apple. Okay, so Apple is an interesting concept given where we reside. I want to talk briefly about what has occurred in the most recent few weeks here that may have been opportunity for an Apple long call option, just to take you back to what we've covered here very recently, okay? When you're looking at Apple, we've got all of this big move to the downside following our Liberation Day notification. What I want to call out, though, is not what all of this nonsense is, but everything that has happened since. And that is the initial move off of the lows to challenge the 20-day moving average, and then the pullback to establish a new first higher low, okay? And that's what we're looking at right here. Now, in the conversation we kicked off today, we talked just a moment ago about when would a trader on the long side, a trader of Apple who wants to believe there's upside opportunity, when would they have maybe said, okay, now I'm going to consider a call option on Apple? Well, I think if we were going to use that example of a hold move, the first might be based on this close here on the 22nd of April. It was a close that was above the high trade on our low day in this pullback, this very brief pullback. So this has the makeup of, for many traders, the makeup of a bull flag that then broke to the upside and gave you your signal, okay? So some traders might have said, hey, near the close on the 22nd, you know what, I'm feeling a little bit more bullish here. Maybe this is my opportunity to participate. What if we went forward a week and looked for option contracts in the neighborhood of the $200 range? I'm just picking on that because on the day that we were looking at 200, or excuse me, the day we closed here, our 20-day in orange, which is our short-term moving average there, was around 204, okay? So this may have been one of those indications that the bullish traders said, hey, I've got an opportunity here, and the fact that we closed above the high of the low day, they may have very well stepped in on a long option. Now, as Luis is asking here, this is a great reminder, we have to be considerate of options and how that may relate to the underlying securities earnings announcement. In this case, earnings are coming here on May 1 into this week, or tomorrow, Thursday. That'll be after market close. Now, the question is a good one, Luis, but the real question is, if you were the buyer here on the 22nd, were you buying an option that was set to expire last Friday on the 25th? Or would you be considering an option that was set to expire this Friday on the 2nd? And it's a fair question, but the trader who says, you know what, I just want to play for next week, I'm going to want to be concerned with how the earnings might play into this. Well, then they could have used this close above the high of the low day and bought contracts that would have expired last Friday, not this Friday, and thus that earnings window wouldn't play into it. Now, if you're looking at Apple today, well, that's a different conversation, because now the only or the first option series you have available is this Friday, which will absolutely encompass this week's earnings announcement. Okay, so if you're looking to purchase options on Apple at this time, you have to be considerate of that. Now, let's talk briefly about that. Since Apple is set to report, as we know, this week, what are some of the considerations that might be on the table for a long call buyer right here? I think the first of them is a pretty clear resistance zone at which we reside. Right now, look, we are right at former support, now potential resistance. Not only is it potential resistance, but some traders would point to the fact that we used it as support here, all well and good. But then when we bounced off of our ultimate low in the short term, where did we stop the bounce? Right at former support, now potential resistance, right? And then where have we paused on this continued rally? In the last 2 days, each time we've gotten into 211, 212, we've seen the sellers take over. Doesn't mean we can't pop through there. Just means it's notable, right? So the option buyer right now might be a call option buyer. They might believe that there is upside opportunity here, but let's look at it. What does that mean in terms of pricing on options? So we're going to navigate on Apple to the trade tab. Here we've got our underlying prices, 210, 50, or 49 by 50, nice and tight spread. And if we are wanting to encompass the options to be announced this week, and Derek, you're absolutely right, it's all personal preference. But let's look at how much bang for your buck is available to the option trader right now. If the option trader were interested in calls on Apple that are at the money, we would be talking about the 210 strike price here, right? So it is 5.25 to buy the 210 today that expires this Friday on Friday's close, okay? Now, one thing we can do to take a quick look at, is this more volatile than the next series, even though price is just a little bit higher, about $1.25? Look at the difference here in terms of expected move. So we've got this implied volatility function, 64.5%, 65% almost for this week. But next week, you'll see that that is lower. And that's because once the known event is completed, everybody, we will then see what's known as the volatility crush, the movement lower in volatility that will erode some of the premium pricing that you see in these existing contracts. That can also, by the way, lead us as traders to see positions that you would think will profit for you, maybe not profiting. Let me give you an example. 210 strike price means that the owner of the Apple 210 call for expiration this Friday pays $525 to buy it. That's $525 to buy the call option. That trader, in order to break even, that stock has to go from 210, has to be at least 215.25 for the trader to break even on the trade, meaning they would be available or in theory able to sell the contract for $5.25, the amount that they put into it. Because any movement under that means that the value of the contract is going to essentially be what's known as intrinsic value. The difference between the current market value and the current strike, that is. So right now, as you look at this, see this price here, 210.4850. The 210 call, all of that $5, almost all of that $5 is tied to extrinsic value, value not associated with the underlying stock's price, right? Because the stock is only 50 cents in the money. So that means that of all of that $5.25, only 50 cents of it is intrinsic value. The rest is that part that can absolutely erode and decay very, very quickly. Okay. So this option trader, if you are a buyer with this week in mind, the risk is that Apple not only could go down, of course, in which case the contract is likely to erode to zero at some point, especially if it's going to stay under 210. But even if it meandered sideways, I use meandered again, Janelle, I'm sorry, you called me out, but I love that word sometimes. Even if the stock went sideways for the entire next 48 hours after the earnings, and it just went sideways at 210, well, then, of course, that $5 value is quickly going to erode. In fact, if it opens at 210 the day following earnings, that contract is apt to be very low in market value because the biggest portion of value associated with that call option price right now is implied volatility, the expectation of a big move, right? So how would this look for us if we wanted to be a buyer of this call? We would just simply click that asking price with my left mouse button. You'll see everything pop up, one contract. I can play with the limit. I'll kick that up a nickel. And then I want to just do a confirm and send from there. I can buy it at a limit not to exceed 5.25. And if earnings go well, come Friday, this would go in our favor, of course. But any price action under 210 on expiration Friday means that the value of this contract is apt to be negligible, if not nil, right? We will need the stock to basically exceed at least 215.25 in order for us to get our dollars back. And that means a move any above 215.25 would bring us profits, but anything under 215.25, there's a really good chance that we're just giving back some of our existing position in terms of the amount of money we spent. But this is a great example, I think, of why traders should consider, hey, that's money that I think is lost. And if I think it's lost and it's anything other than lost, great, I will take that from the trade. But if you're thinking about risk from that standpoint, the odds are strong that you have found your true risk, right? What I want to discourage you from doing is spending more than you really have comfort for. And I have found in my own experience, as well as the experiences of many traders with whom I speak, that we tend to overdo our investment dollar. We tend to believe that the upside is greater than the downside. That's just a human nature viewpoint. And I want to try and save some of us from that. Okay, so let's, you know what? I'm going to go ahead with it. Let's put this trade on. It'll give us something to check out. I can look at this next week. I will be back with you all next week, but we'll have to look and see how this one performed, obviously, with earnings. And this contract will certainly be expired on Friday. We'll just have to see how it plays out for us, right? Okay, another thing that I wanted to point out, though, is we talked about this 65% volatility and what it can mean for the trader. The $10 that you see to the right of that, I just wanted to give you a quick definition. Essentially, what that speaks to is the expected price move that a trader might get from the Apple position post earnings, meaning that all of the values associated with the contracts imply that Apple is likely to make a $10 move one way or the other based on earnings. That's never a guarantee. These are all exclusively probabilities, right? So it's just suggesting there's probably a 2/3 possibility, if you will, that we're going to see a $10 move, but it doesn't have to happen that way. And if you got anything, as we've seen here, anything less than 525 on Apple, assuming it closes today at 1050, anything less than 525 to the upside is going to likely result in us losing some kind of funds on the option contract. So please keep that in mind. Now, I am going to show us a position with a little bit more volatility. And I also want to highlight that you can add a measure for volatility that will aid in maybe discerning when a stock can give you reasons for consideration. One of the things to keep in mind is that implied volatility tells us we're spending more. We are getting less bang for our investment buck. And we want to be better than that, ideally. So one thing we can monitor is implied volatility. And you can place that on your chart in the daily viewpoint here to get an idea as to where volatility might reside relative to historical levels. And if we look at Palantir, for example, let me just highlight, I'm going to shrink some of that and then bring this back. Obviously, implied volatility was enormous on Liberation Day, right? We had a lot of risk and a lot of concerns and a lot of headline risk. But if we go back to the last earnings, you'll notice that implied volatility was high here too. But look at where implied volatility is now on Palantir, and you'll see that we remain above where we were the last time, and we have earnings coming on May 5 next week. So as we navigate over to the trade tab, and not this week, well, let's just for our purposes look here quickly. 87% volatility, still very high, implying a $7 move between now and Friday expiration. Not that that's a shock, that's still a 5% move. That'd be wonderful on the stock. But look at next week's expiration, which will encompass the earnings announcement. It's 125% volatility, and it's an implied $19 move, a possible 10+% move on the position. Okay, so what does this tell us? It tells us that if we want to play Palantir earnings, we might have a good opportunity, but it's going to be costly. And that means that we've got to assume some substantial amount of risk, right? What do we need if we want some of these contracts to be valued? I mean, we'd have to get a $9.50 move, which granted, according to the stock's implied volatility, is entirely within reason, right? But we'd have to get a $9.50 move for that to maintain profitability for us at our current market, right? At the money is what we would call that. So that might work out, but it's going to be costly to do it, $945. Now, the same trader might say, you know, that's all well and good. I'd love to speculate on the upside, and I'd love to spend fewer dollars to be a buyer and participate in that upside. But I want to give you an alternate thought process. And I want to remind before I do that I'm not recommending Apple, of course, and I'm not recommending Palantir, and certainly not recommending this as a strategy relative to Palantir, because this is going to actually be a little bit more costly because we are looking at Palantir with high implied volatility and a high implied move come next week's earnings. But one thing that some traders may consider, if you were the investor who said, I'd love to own Palantir, but I don't want to own 100 shares because I don't want to spend $11,000 to do it, right? So that trader says, well, how much would I like to spend? What if the trader said that they'd be comfortable spending about $1,500, well, let's say half, let's say, or less than half, let's say only $2,000. I'm going to have to increase my strike prices here, everybody. Because what I want to look for, I'm going to have to go to 30. I'm looking for the $100 call. Whoops, got one too many in there, sorry. All right, here's the 100 level. The 100 call, everyone, is going to make me spend almost $1,800 to buy the 100 call option on Palantir. Now, why would a trader buy a call option so deep in the money versus where we are today, right? It's 114. This contract gives the owner the right to buy 100 shares of the underlying stock, but not everybody is wanting to buy the underlying stock and hold perpetually. Many of you just simply want to participate in the upside opportunity. Well, one consideration is to go deeper in the money and get a position that will possibly maintain more of that market value after earnings. Yes, some of this implied volatility will come out of the $18 price level or the $18 you spend, but if your goal were simply to participate in upside opportunity and make and maintain some market value associated with your contract, well, you could certainly purchase the 100 call. And what do we have to be at in order for this to be valued? Well, we'd only have to be at expiration at 118, up $4 from where we are, right? And then you'd be basically at a break even. And anything but bigger than that to the upside would certainly bring you returns, right? Some actual profits in the scenario. But the consideration is simply recognizing that, yes, I have to spend more, but I am also at a greater likelihood of being in the money on expiration Friday, and thus a greater likelihood of there being value associated with the long option that I chose. Okay. And then lastly, what if you just said, yeah, that's all well and good, but I don't care about the earnings. I just care about the opportunity to participate as though I was an owner of 100 shares of Palantir. And I want to do that between now and, maybe January of next year. You could absolutely do that. And yeah, you're going to be spending more. But again, how much more? Not a whole lot, right? The trader who wants to buy 100 shares of Palantir today is spending $11,455-ish right now. But if you wanted the same concept, the same opportunity in theory, between now and the end of January, the expiration in next January, you could have this same represented ownership in Palantir for $3,500, right? $35 a contract times 100 shares of the underlying stock. That's what that represents for the owner. And so I think that that's something that often falls by the wayside as investors are getting familiar with what option contracts reflect and represent. But it is absolutely something for consideration. And of course, I have to leave you with a reminder that doesn't mean that value remains. Right? If Palantir drops from 115 down to 100, we can absolutely expect to lose money there on the underlying call. But the opportunity, if you believe there's more upside, is certainly there for the trader. It's just a matter of defining what is it I'm looking for. Do I want to spend a little bit for the opportunity to profit in the very quick short term, this week, next week? Do I want to have reflected ownership in the underlying stock without having access to proxy votes and dividends? Or, what is my process? What is it I'm really looking to accomplish? I hope that's helpful, everybody. This was, the first time I've taught this class in a very long time, and I wanted to bring some of that conceptual trade management into the discussion for all of you. So I hope that was helpful. Now, next week, I am going to be back here with this class again, but we are going to be doing put options on this one, okay? So reminders for you as takeaways for the end of the class here. Remember, we might be looking for some opportunities based on expectation of the move. So profitable trades, you might consider hitting an upside target. For the unprofitable trade, some traders do incorporate prices reaching their max pain level and moving on. Again, don't forget to consider, however, the idea that instead of utilizing stops, maybe you want to simply incorporate max loss as part of your willingness for purchase, right? So beyond that, earnings on special events absolutely have a lot to do with things, right? They can give you greater costs to your option contracts. Earnings have a big part of that. Known events that are broad market relevant can also have a big part in that as well. And then some more considerations for you. Remember, if we're buying calls, you need to be bullish on the underlying stock. Generally speaking, that's your first step, right? Consider your various strike prices when we're thinking about our opportunities. Evaluate support and resistance and utilize those as helping out. And don't forget to consider the expiration date and whether you need to give yourself some more time. And then while it's not here, I'm just going to remind you, you do not need to hold your options to expiration. The buyer of a long call can be the seller of a long call very quickly, particularly if the position moves to profit very quickly for you as well. Okay. So with that, thanks to JB. Thanks to all of you for being here. Follow JB and me on X, James Boyd CS and Kevin Horner CS. And if you like today's discussion, hit the thumbs up button down below for me. I noted that JB did put the link for this class into the chat here. You're welcome to utilize that. Cameron's been teaching this class for a very long time. And if you're looking for more from this class, you're absolutely going to find it in the archive there. So with that, I'll wrap it up. But thanks for being here. Have a great rest of your Tuesday, everybody. I will see you all again real soon.